In this video, we're going to go through these 4 news stories to help you stay commercially aware, especially if you're interested in banking and finance careers. I'll summarize each one, include a few key takeaways, and then share some thoughts and opinions for you to use when you're networking or in your applications and interviews. For those of you that are new here, my name's Afzal Hussain. I started my career at Goldman Sachs, and since leaving, I've helped hundreds of thousands of students and graduates get further in their banking and finance career journeys. Enough about me, let's get straight to story number 1. So Morgan Stanley is modifying its pay structures after the UK's removal of the cap on banker bonuses, aligning with similar moves by other banks including Goldman Sachs and JP Morgan. This internal bonus cap aims to maintain competitive compensation and attract top talent in London's financial sector. European banks, unfortunately still restricted by EU rules, face competitive challenges due to these changes. Key takeaway number 1, pay structure changes. So Morgan Stanley's new internal bonus cap is a strategic move to align with the UK's recent regulatory changes, which are part of the broader effort to enhance the City of London's financial sector's competitiveness post-Brexit. This shift reflects a significant change from the previously mandated EU cap on banker bonuses. Make sure you hit the first link in the video description to subscribe to my free daily newsletter, where you'll get a deep dive on different articles and stories once a day, every day, Monday to Friday, to keep you commercially aware. Number 2, competitive compensation. By adjusting its bonus structure, Morgan Stanley aims to ensure that its compensation packages remain attractive in the highly competitive financial services industry. This change underscores the bank's strategy to reward high performance and maintain its reputation as a desirable employer in the sector. Key takeaway number 3, impact on hiring. So the changes in compensation structures are expected to impact recruitment, with Morgan Stanley and other banks potentially attracting more top-tier talent from a global pool. This move is part of a broader trend among financial institutions to leverage more flexible compensation packages and policies to attract and retain skilled professionals in London's financial hub. European banks' concerns. So European banks still adhering to the EU's cap of bonuses being limited to being no more than 2 times base salary might find themselves at a disadvantage in hiring and retaining talent. These banks argue that the UK's regulatory shift could create an uneven playing field, complicating their competitive strategies in the global financial market. And last but not least, varied approaches. So different strategies by leading banks like Goldman Sachs and JP Morgan highlight the varied responses to the regulatory changes. Goldman Sachs, for example, has significantly increased its bonuses while reducing its base salaries, reflecting a high-risk, high-reward strategy. In contrast, JP Morgan's approach of maintaining fixed salaries but allowing substantial bonuses aims to balance stability with competitiveness. Now onto my personal thoughts. So 1, strategic move reflecting industry shifts. So Morgan Stanley's decision to alter its pay structure highlights the need for financial institutions to remain flexible in response to changing regulations. US salaries have been higher than their UK and EU counterparts for the longest time. To add, bonuses in the US are uncapped, making it more of an attractive destination for bankers to consider building their careers. By uncapping bonuses in the UK, firms are once again able to compete for the best talent globally. 2, broader implications for financial services. This move could influence other banks, potentially setting new industry standards for compensation, which is great for employees. Different approaches by Goldman Sachs and JP Morgan illustrate that there isn't a single solution for all institutions, providing valuable insight into compensation management. Ask yourself, would you rather a higher base salary and lower potential bonus, or a lower base salary and a higher potential bonus? Everyone's going to have a different answer. It's case by case, individual by individual. There's no right or wrong answer, since it's all dependent on individual circumstances. But it's nice to know that a variety of options are available for you across the industry and across regions. Number 3, challenges for European banks. The playing field is leveled for the UK to compete with the US. However, the big losers here are the EU banks. The move spotlights challenges faced by European banks due to different regulatory environments, which might encourage discussions on the need for uncapping bonuses in the EU if they want to stay attractive as a destination for financial service professionals. Figuring this out is vital for maintaining stability and essentially ensuring financial services careers remain competitive. Alright, the next story is an interesting trend among MBA candidates. So MBA graduates are increasingly opting to buy and run small businesses instead of joining traditional trainee programs. This trend focuses on acquiring undervalued small companies and applying strategic management to boost their value. Search funds often target businesses with between $10 million and $100 million, particularly those with retiring founders seeking liquidity. Despite the potential for high returns, financial rewards for search fund entrepreneurs are typically moderate, leading many to pursue multiple ventures. Key takeaways from this article. So 1. Rise of search funds. MBA graduates are turning to search funds to buy and manage small businesses. Graduates are increasingly opting for search funds to gain hands-on business management experience by acquiring and running small companies. The concept of search funds was developed through research at Harvard and Stanford, with a record 93 search funds launched in 2023. Number 2, target market. So these funds target a niche market of smaller enterprises between $10 and $100 million that are overlooked by large financial institutions. A significant portion of the acquisitions involves businesses where the original owners are looking to retire and seek liquidity, i.e. they want cash out of their business and they want to kind of move on. 3. Financial backing. These firms not only provide the necessary capital, but also offer strategic advice throughout the acquisition and management process, from identifying potential targets to structuring the purchase and planning of the eventual exit. These firms play a critical role in the success of search funds. Number 4, deal characteristics. So typical acquisitions are around $15 million, bought at 7 times EBITDA, so earnings before interest, taxation, depreciation, and amortization. The average deal size is relatively modest, focusing on companies with strong earnings potential. Annualized equity returns for successful exits have been well above 30%. Historically, these investments have yielded high returns, making them attractive despite the inherent risks. The 5th key takeaway is the career path. So managing a small enterprise offers invaluable real-world experience that can be more beneficial than traditional corporate training programs. While not immediately lucrative, it offers significant entrepreneurial experience and potential for future wealth. Personal thoughts on the article. So first, practical learning and real-world impact. So the trend towards search funds underscores the value of practical learning. By directly managing a business, MBA graduates gain real-world insights and skills that are often not fully captured in traditional trainee programs. Number 2, the market niche. So this approach highlights a largely untapped market for small businesses that can benefit from strategic management and financial backing. It provides an opportunity for significant growth and value creation in sectors that larger firms often overlook. Number 3, entrepreneurial drive. The rise of search funds reflects a broader entrepreneurial spirit among new graduates. This hands-on experience fosters innovation and leadership, key traits for future business leaders. Number 4, investment potential. For investors, supporting search funds can offer attractive returns. The high equity returns reported by successful exits make this a compelling investment strategy despite the risks involved. Last but not least, number 5, long-term vision. While the financial rewards might not be immediate, the long-term vision and experience gained through managing and growing a small business can lead to substantial future opportunities and wealth creation. The next news story is fund managers forego billions in fees in race to the bottom. Asset managers lost billions in fees as US fund investors shifted from mutual funds to cheaper exchange-traded funds in 2023. Morningstar's study shows a continued decline in average expense ratios and a significant redirection of investments from actively managed to passive funds. Although firms like Dimensional have adapted by offering actively managed ETFs, this shift has led to lower fees and internal competition. While fee pressures persist, there are signs of stabilization, with some funds even raising fees. The first key takeaway is the significant fee savings. US fund investors saved around $3.4 billion in fund expenses last year, with these average asset-weighted expense ratios dropping from 0.37% to 0.36%. The shift to passive funds. So actively managed funds saw large outflows, with money moving to cheaper passive funds in the last 2 years. Passive funds attracted over $1.1 trillion in net new money, while active funds lost almost $1.4 trillion. Number 3, active managers adapting to ETFs. So firms like Dimensional have successfully entered the ETF market, though this has led to lower fees and competition with their mutual funds. Active ETFs are generally cheaper than their mutual fund counterparts. Persistent fee pressure. The demand for low-cost funds remains high, with the cheapest 10% of all funds cutting fees nearly in half over 15 years. The cheapest 20% of passive funds generated 90% of all inflows in the past 2 years. And the 5th key takeaway is signs of fee stabilization. So both Morningstar and FactSet indicate fee pressure might be bottoming out, with some funds starting to raise fees. This change is partly due to outflows triggering automatic fee adjustments. So a few personal thoughts. Impact on asset managers. The ongoing shift from mutual funds to ETFs highlights the need for asset managers to adapt to investor preferences for low-cost options. This transition is challenging traditional revenue models, but it also opens opportunities for innovation and efficiency improvements in fund management. Investor benefits. The trend towards lower fees directly benefits investors, reducing their investment costs, potentially leading to better net returns. This shift underscores the importance of transparency and competition in the financial industry. industry. The future of active management. While passive funds continue to dominate inflows, there still is a role for actively managed funds, particularly those that can demonstrate consistent performance and value. Asset managers need to balance cost management with delivering superior investment strategies. Regulatory considerations. So as the industry evolves, regulatory frameworks may need to adapt to ensure fair competition and protect investor interests. Continuous monitoring and potential adjustments to regulations could help maintain a healthy financial ecosystem. Long-term outlook. The finance industry is experiencing significant changes driven by technology and shifting investor behaviors. Asset managers who navigate these changes effectively will be well positioned for future growth and success. And the last story we've got for you today is Wall Street reports best quarter for investment banking in 2 years. So Wall Street's largest banks, including Goldman Sachs, JP Morgan, Morgan Stanley, Bank of America and Citigroup, reported their best quarter in investment banking in over 2 years, with combined fees of $8.2 billion in Q2 2024, a 40% increase from the year previously. The positive outlook is driven by a resurgence in deal making and debt underwriting, despite some mixed quarterly results. Key takeaways saw strong investment banking performance. The top 5 investment banks reported $8.2 billion in investment banking fees for Q2, marking a 40% year-over-year increase and the highest level since early 2022. Number 2, positive outlook. So executives from Morgan Stanley and Goldman Sachs anticipate continued recovery in investment banking, with Ted Pick of Morgan Stanley suggesting the start of a multi-year cycle. This will likely mean a better compensation environment in the coming years in terms of base salaries and bonuses. Debt underwriting surge. So debt deal fees outperformed other areas, with revenues rising over 50% to $3.7 billion as companies seek to refinance or raise new debt amid stable interest rates. Mixed quarterly results. So even though investment banking revenues were strong, Goldman Sachs underperformed expectations. Meanwhile, JP Morgan, Citigroup and Morgan Stanley saw higher than expected revenues. And the 5th key takeaway is equity and M&A activity. So equity underwriting revenues rose by 36%, driven by significant deals like Webtoon Entertainment's IPO. M&A advisory revenues grew by 25%, with potential high-value transactions in the pipeline, such as Google's talks to acquire Wiz. Personal thoughts on the article. So resilience of investment banking. The notable recovery in investment banking activities highlights the sector's ability to bounce back from a significant downturn. After a prolonged period of subdued activity due to rising interest rates and market volatility, investment banks have demonstrated resilience by capitalizing on improving market conditions. This rebound signifies not only the sector's robustness, but also its capacity to adapt to changing economic landscapes, reinforcing confidence in its long-term viability and stability. Debt underwriting surge. So the substantial increase in debt underwriting, facilitated by a more stable interest environment, exemplifies the market's responsiveness and adaptability. As interest rates have stabilized, corporate borrowers are seizing the opportunity to refinance or raise new debt, leading to a surge in underwriting activities. This trend underscores the dynamic nature of financial markets, where participants quickly adjust strategies to leverage favorable economic conditions, thereby ensuring continuous growth and liquidity. Positive future outlook. So the optimistic outlook from executives suggests the potential for a sustained growth cycle in investment banking. This strategic optimism is grounded in the belief that as economic conditions normalize, the sector will experience a multi-year expansion driven by increased deal making and capital market activities. Such a positive future outlook not only boosts investor confidence, but also signals the readiness of banks to capitalize on emerging opportunities and drive long-term growth. Number 4, equity and M&A activity. So the rise in equity underwriting and mergers and acquisitions activities signals a robust recovery in strategic financial transactions. This growth indicates that companies are increasingly in capital raising efforts and strategic mergers to enhance their market positions. The uptick in these activities reflects a healthy investment environment where businesses are confident in pursuing growth and expansion through strategic deals, further fueling the momentum in capital markets. That was 4 news stories for today's Finance Focus update. If you made it to the end, make sure you hit the first link in the video description to subscribe to my free daily newsletter, where you'll get a deep dive on different articles and stories once a day, every day, Monday to Friday, to keep you commercially aware. I'll see you in the next one. Peace.